And of course, the question remaining, what does all of this mean for equities? Well, my next guest has been saying all along inflation is transitory. The big problem now is deflation. That's the basis of her strategy for investing in 2024. She's also been making news with her X Spaces chat yesterday with Tesla CEO Elon Musk on a wide range of issues from passive investing to the future of AI. Joining me now with an exclusive interview on the exchange is Cathie Wood, CEO, Chief Investment Officer of ARK Invest. Cathie, happy holidays, Merry Christmas. Good to see you. And it's especially merry, it seems, for ARK because you're up 46% since Halloween, right? And more than 70% year to date after a couple of rough years. So what shifts do you make here?
Well, what we've been doing during the tough years when interest rates were going up and shocking the system, especially long duration assets, we concentrated towards our highest conviction names. Now that we have had a very nice move in the market and interest rates and inflation seem to be under control, we do believe we're going to see deflation next year, and that the Fed will have to cut pretty aggressively. But we do think we're on the other side of the horror show we went through. And we think that companies that are comfortable with deflation as technologically enabled companies focused on innovation are going to do very well in the next few years.
Well, that doesn't sound any different from what you usually think. So are you going riskier?
Yeah, well, many people would say what we do in the downturn, concentrating towards our highest conviction names, is a risky strategy. It usually works out very well for us. We have a scoring system that really helps us along. Now we're diversifying more.
Okay.
And we should we expect the IPO window to open up again. There are a lot of companies out there starved for capital, have been waiting for their liquidity event. So it's a good time to diversify and also to add back in some of the names we sold as we were concentrating, perhaps because of more clarity in their own outlooks.
But that sounds like, and correct me where I'm wrong here, it sounds like you're saying if you're diversifying beyond your highest conviction names, then you're going into names that seemed riskier for you, for whatever reason. So why were these types of names lower conviction in the past? Are they smaller caps in the public market? Do they have a more uncertain path to profitability? Are they perhaps in second or third position in the markets they're trying to capture?
Well, some might surprise you. One of the ones we've added back is Meta Platforms. It's not a big position. We've been taking profits out of some of our stocks and reallocating back to Meta. Why? Well, when we sold it, we were not crazy about the metaverse strategy and how much capital Meta was allocating to that particular strategy. When Mark Zuckerberg pivoted effectively into his AI strategy, we think they're in a brilliant position from an AI point of view, and they're really pushing the envelope on open source AI, which should help them in their own business.